Welcome to the Mind Money Spectrum podcast, where your hosts, Agte and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
Hi, my name is Agte. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today, and thanks everybody for listening and watching.
Great to be here as well. So a few weeks ago, in one of our other conversations with a fellow advisor and friend, she told me that she had gone to Park City, Utah to go skiing for vacation. Well, another thing, it's probably more than a few weeks ago, since we're past ski season.
Was I in that conversation?
You came in late.
Okay.
And so she asked me if I've ever been to Park City. And I was flooded by these memories that started me down a path to where I am today. So today is the start of my only trip to Park City, Utah. And it's going to end with why fee only matters.
Okay, I'm excited. Is this the origin story of Aaron?
I'm not quite as close. It's like a fundamental tenet of Graystone Advisor. I feel pretty comfortable saying that.
Mm-hmm.
So, not necessarily the origin of me, but this is like before I had thought about ever starting my own business. This was like a fundamental belief.
Well, it's like when Peter Parker became Spider-Man, right? He had the bite, and let's see, Batman, right? His parents died, and that made the transition, right?
It is more like so this is like a super small Marvel Cinematic Universe detail. When Peter Parker is talking to Tony Stark, says, I couldn't play football before, so just because I got these powers, I shouldn't play football now. It's kind of like that decision that is kind of throwaway, but it's actually really fundamental to the character, like the honor within Peter Parker to be that good person. Mm-hmm. So, because he could have been a great football player, but instead he's going to be a superhero.
Okay.
So, but I guess now I say that, I'm not comparing our career to superheroes, but I can see how we might accidentally get there.
I gotta put away my cape and face mask for this episode then.
So XY Planning Network, which we're both part of, one of their t-shirt slogans was financial planner because my red cape is at the cleaners. So I thought that was a little too much, but maybe the story's comparable.
Well, so. I'm excited.
Okay, so going back 2008, there's a big financial crisis. Lots of stuff was down. Bonds and stocks were both down. I had been in the industry for 3 years, and I was working at a mid-sized RIA as the director of financial planning. And we were looking at things kind of as our clients had gone through 2008, going now 2009, 2010, like as we kind of recover, we had done a lot of like tax loss harvesting, but now we're like, okay, is there something we could have done better? Like what lessons can we learn from this? And one of the things that looked particularly attractive was non-traded REITs. This was an investment class that had been able to provide more consistent cash flow and dividend through this period. And we were curious, like, okay, what does this work? What does this mean? Like, how can this work? Could this help our clients? So around 2010, we started looking at different non-traded REIT companies. So a REIT is a real estate investment trust. This is a collection of actual real estate properties that is pooled together and can have smaller individual investors. You can buy publicly traded REITs. You can look at REITs on a publicly traded market. So you can go to the New York Stock Exchange or any other stock exchange and buy a REIT that's a collection of a large pool of real estate properties. These are non-traded REITs. So these are private investments. Their goal is usually to use pool investors' money together, build up a decent portfolio, and then sell that portfolio to one of these larger publicly traded REITs. That's a common strategy because the large REIT doesn't necessarily want to buy one property at a time. They want to buy 20 to 50 properties at a time. So
are these mortgage-backed securities at that point?
Mortgage-backed securities is I'll say a cousin of these. You can have a similar structure. That would be called a business development company, where they are mostly doing the actual mortgages, the actual lending. So they're doing the lending to real estate, and they can sell that pool of mortgages. But this is actually they're owning the actual properties. They will use different amounts of leverage. So some properties, they might have a 50% mortgage. Some properties might be a little lower, some might be a little higher. And you're kind of hiring the REIT managers to make these decisions for you. But going back probably on a scale of 10 years at least, so like 2000 to about 2010, they were providing a pretty consistent 6 to 7% dividend, and then upon exit could usually provide some additional premium of, let's say, 2 to 5%. Kind of like, and they had actually done this pretty well, and a lot of them have worked out well. They were also go ahead.
So just so I'm clear in my mind, so it seems like the distinction is with the non-traded REIT, you actually have ownership of the underlying assets, meaning the real estate itself, and you're investing in that property. Whereas with the MBS, you're basically just taking over the loan portfolio of the properties which you don't own, but you're making money off of the loans themselves.
Correct. This is a small distinction, but the REIT owns the property, and you are one of the partial owners of the REIT. Right. Yeah, you're a shareholder of the REIT.
Right.
And these REITs, they tend to have an even $10 share price. They're paying their dividend based on that share price. If they are getting more income, so that they have certain rules, like they have to pay out 90% of their income. You can get depreciation passed through. So especially early on in the non-traded REIT cycle, a lot of the dividend could be mostly tax-free because a lot of the depreciation is being passed on at the same time. They don't hold on to the rental income, so that they don't really kind of reinvest rental income into buying the next property. They're raising money to buy the next property. And so as long as they have that portfolio, you can feel a little comfortable that the rental income is passing through to you. Again, you're usually buying larger commercial properties that's hard to do at the individual level. So you're not buying a single family home, you're buying an apartment complex that might be $10 to $20 million. You'll be buying a grocery store, like strip mall chain kind of thing. Like so there'd be like one big box that attracts most people, and then the dozen stores next to it are all owned by the same property. And so that big box is kind of what attracts people to that area, and you can probably make a little bit of money there. And all of the other ones, because they're smaller, you can probably get a higher like rent per square foot kind of thing, and so that can provide some premium. The big box also tends to be a triple net lease, which among other things means that the tenant takes care of the maintenance, and the tenant takes care of a few other things. So there's fewer out-of-pocket expenses for the owners as the landlord, which is different than like a single-family home where the landlord, the owner, has to pay for all the upkeep and maintenance.
Right.
These tend to be long-term leases on the big box, so 10, 20, 30-year leases with usually like a 3 to 5% annual increase on rent. So again, it's not a huge upside there, but the other ones, they either have shorter term leases to get a little more turnover that allow you to increase rents a little more than that 3 to 5% per year. This is an example. You could also do warehouses. So Amazon doesn't necessarily want to be in the real estate business. They want to be in the shipping and distributing business. So you buy the big warehouses. Then there's other categories, like you could do self-storage, like storage units. That was another category where, again, it's hard for an individual to buy the whole place. But if you pool money together, you're getting a large. And so now the REIT owns the buildings and the land, and the company is going to rent out that place, and the other company is taking care of the management of that.
Right. So I was going to say, it sounds like this is like the distinction between a publicly traded ETF fund and a private equity vehicle designed to do some specific small opportunity and then find investors for that specific opportunity and then move on to the next thing, or like venture capital or something like that.
Yeah, it's quite closer to like a venture capital or private equity, where the private equity, the firm itself, is trying to make deals in a dozen different companies.
Right.
And they're going to provide advice and try and help each of those companies, but not all are going to make it. So, and you're reducing that risk of, if one of those properties burns down, you have a portfolio of properties.
Yeah.
But you're still trying to keep some of the benefits of owning real estate, mostly like the depreciation, and a few other tax deductions like mortgage interest deduction. So you're trying to keep those tax deductions, getting the rental income plus a little bit of appreciation on the upside, without putting all of your portfolio in a single family home that you buy yourself.
Right. So like, for example, you could get a publicly traded REIT, which would have a very large basket of properties that's traded on the exchange, so you can get in and out as you need to. But this is probably a little more esoteric, maybe certainly not the liquidity you would get with a publicly traded instrument.
Correct.
So you're locked in for a long period. Yeah.
The two, so on a non-traded REIT versus public traded REIT, the two big differences are, one, the liquidity versus the illiquidity. And so you get an illiquidity premium. So that appreciation when you get out, usually there's some hurdle that they pay the investors first before the REIT manager takes their cut. So that's part of the illiquidity premium. And the larger the portfolio, and on the publicly traded REIT side, it tends to correlate with the stock market more and more. Just economy's up, this does tend to do well. Economy's down, this tends to go down. And a non-traded REIT tends to have a lot less correlation to the U.S. stock market and U.S. bond market. And that's actually one of the big reasons why we started looking at this, is that non-correlated asset class. Because in 2008, again, we had our 60-40 portfolio. We saw stocks and bonds go down at the same time. And we were sort of like, is that an aberration that we haven't seen over the last 100 years? Or could that happen again? And how can we prepare for that?
What you're kind of also seeing is more idiosyncratic risk, less diversification within the non-traded REIT, which is why it likely commands a premium, because you don't have the liquidity and you don't have the diversification. So you got to make up the benefit someplace else. And that might come with potentially a higher return, but just more risk, because it's basically tied to a small segment of the population of real estate investments. And depending
Correct.
on whether that segment outperforms or underperforms, you can do really well, or you can do really poorly.
Yep. So if you ever hear real estate is location, 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 if
Right.
you go to a big nationally operated, a publicly traded REIT, we've removed all the location concerns. Now you're
Right.
just getting the national average.
Yeah.
The non-traded REITs are small enough that each individual property still makes a difference, and so location does matter again.
Yeah.
You're again getting that idiosyncratic risk that can be a high risk, high reward kind of thing. Like it can
Mhm.
help improve return. It can also hurt.
Right.
And you're trying to hope that you can reduce the hurt by having 20 properties. And so if you have
Mhm.
them spread out enough, you might be
Yeah.
able to reduce that a little bit.
So then you capture that excess premium for like illiquidity, but you also get some diversification out of having so many, for example, venture capital deals. Then on average, you kind of come out ahead.
Yeah. Along with the fact that using leverage on real estate works pretty well, especially we were in a low interest rate environment at the time. And so you could kind of choose how much risk you wanted to increase or decrease. Not you as the individual investor, the REIT manager,
Right.
they would choose, okay, if we're trying to reach this dividend, we want this cash flow, we're going to put this amount of mortgage on it.
Hmm.
And so a lot of times they would use floating rate mortgages because the interest rates were even lower and they weren't necessarily planning on holding these properties for 20 years. Like they're trying to hold it for 5 to 10 years. That was a kind of expected time frame.
Hmm.
Trying to target about 7 years, but acknowledging it could be 5 to 10.
Right.
So I think that's a good description of non-traded REITs. We were starting to look into these. Okay, this could be something. It's not correlated to stocks and bonds. It seems to provide a good dividend. We got to learn more about this. So we started taking calls and reaching out to different non-traded REIT companies
Okay.
and kind of learning more about these different companies. And one of the things that they would offer to do is, again, to help us learn about the different companies, because there'd be different sponsors. I was probably a good 6 to 8 sponsors that were well known. And
Yeah.
within each sponsor, there's 5 to 10 programs going on at any time. Like they have their apartment REIT, they have their warehouse REIT.
Right.
And so like we have to learn more about this. So they invite us to a due diligence conference.
Yep.
That instead of them going out to each individual advisor that they're trying to recommend, like, hey, why don't you come to our place and you can, all 50 of you can learn about this particular REIT at this time.
And to be clear, this is 2009, 2010?
2010, 2011.
Okay, so after the big real estate crash of the great financial crisis in 2008.
Correct.
Okay.
So again, these programs had done pretty well through 2008.
Now, that has me scratching my no hair for a second. Why did they do well when real estate did quite poorly over that period?
I want to say it was probably that the risks they took on weren't that dramatic. Like a lot. This is more guessing, but a lot of the real estate market was in single family homes. It was individuals who were taking on debt, like 0% down payments, that when interest rates rose in 2006, 2007, they couldn't meet those debt payments. So because the REIT companies had stable corporate tenants, and they didn't have that much leverage, the cash flow was pretty consistent. Even if the property values went down, a lot of the kind of the REIT valuation is a combination of not only property values, but the consistency of the rents coming in.
Okay. I have a slightly different theory, but you might even address this a bit later, so I
Okay.
can hold off.
But again, it's I think that there's also, yeah, I want to say it was the combination of being mostly corporate and or apartments, that as long like the tenants were still paying the rent kind of thing. There wasn't the vacancies and or defaults on the mortgages at these levels.
Right. Yeah,
Okay.
they probably didn't go in with 0% down, interest only.
Yep.
As
Correct.
we heard about around that time.
Yeah. So I went to, one of the due diligence conferences I went to was, we had to fly to New York, and like I flew in because it's a long flight from the Bay Area. I had to get to the airport like 5 a.m. 5-hour flight plus losing 3 hours to time change. They have a dinner the night before. They're paying for the hotel, and then we have the conference the next day. And so I have this really nice picture. So again, 2010, I am in my late 20s. Like I think I'm like probably 27. Okay. I think I don't have kids yet. That I don't make a ton. So the fact that they're paying for the flight and the hotel to go to New York, it's like the advisor I work for, they could have done, but they didn't have the time. They didn't want to do this. So like, let's send the guy in his 20s to go do this. So the dinner the night before was at this really nice hotel building, but it's at the top of the building, has an outdoor balcony. It's overlooking Central Park.
So
I have this picture of me.
You're getting wined and dined here.
I'm getting wined and dined. Yes, exactly. I'm getting wined and dined. Right. And like, okay, this is pretty nice. Another one was in Chicago. I stayed at the Trump Hotel in Chicago. So again, this is 2010. So this is before any kind of negative connotations. But first time I saw a TV inside the mirror in the bathroom, so that you could watch ESPN as you're brushing your teeth in the morning. Mm-hmm. And one of them was in Park City, Utah. So this is in the winter. So I was snowboarding time. You know what? I'm going to fly out a date early. They're paying for the flights, so I kind of coordinate with that. They take care of the ride from Salt Lake City to Park City, because that's the major airport. It's like a 40-minute drive. I stay in a hostel for one night on my own dime. Mm-hmm. I go snowboarding, and then I go to the hotel that they're paying for, which is at a ski-only resort. So this is also the first time. Did not know that ski-only resorts existed.
Right.
So this is like.
Where else would you hold a conference for financial professionals? You're looking to?
Because like I want to go snowboarding like at the place that we're staying at, but like no, sorry, it's ski only. Because again, in 2010, the snowboarding was not fancy enough.
Oh boy, wow!
It was ski only because they didn't want the skiers to have to deal with the snowboarders.
Yeah.
So,
oh boy,
went to that conference.
For the record, Aaron and I are both snowboarders.
yes. So, my daughter was not born yet; she had not turned 5, so I hadn't started learning how to ski yet. So I was only snowboarding at this time.
Yeah,
and there was around this time. So again, this is like 2010, 2011. We had done some of these different investments, and for each client, we were doing like 100,000 split across 4 or 5 different programs. So like different sponsors, different programs, $20,000 to $25,000 each. And we're starting to see some of the returns, and like they're doing what they're supposed to. There's even I think from early 2010 to middle of 2011, there was one program that was able to we had gotten kind of at the right time, like late in the program. So they actually went full cycle. So they sold their portfolio, and our clients got like a 50% return on that one particular program because it was $10 share price. They sold it for 15, in addition to getting a 7% dividend for a year. So like the clients got like something like 22% on this one thing over 1 year.
Yeah.
And I'm starting to kind of learn more and more about these. And I think Park City was the last one I went to. So I think it was about 2011. It was for a grocery store REIT. And again, it was nice hotel, the ski and resort. And I'm starting to learn more and more about it. And I found a Blue Vault report. This is an independent third-party analysis of non-traded REITs.
Like Moody's or S&P.
Kind of, yeah. And I'm just coming to this realization, like the wined and dined, the money that's going to paying for my plane ticket and my hotel room and the nice dinner is coming directly out of the fund expenses, which comes directly out of the client's investment.
Yeah.
And I start, again, because I'm doing the research on like, is this a viable investment?
Yeah.
I don't get paid the commission. My bosses got paid the commission. But as I go through those Blue Vault reports,
from that investment, just so everybody's clear, the commission is right.
And so like they pay my salary,
fees, I guess, or some analog of that.
It wasn't 12B51Ps because those would be mutual funds, but it was there's the advisors who sell get a 7% commission, just right up front.
Front load.
It's front load. There was.
Let's be clear about this. You put in $100,000, $7,000 disappears immediately.
Yeah.
Okay.
There was something like a 2% management fee by the REITs, by the sponsor, by the REIT company.
Did I even do that math right?
Yeah.
$7,000, okay. And then
there was it's at least 2% for the management fee. There was
$2,000 per year.
There's also like placement costs and a few other fees. And I remember when I started going through the Blue Vault report, again, like 2010, we started doing this. Only about 2011, it's like, okay, I kind of see what's money going. There were a lot of programs for every dollar a client invested, 83 cents went into the ground. 83 cents went into actually purchasing real estate.
Right. So like 17%.
17%. Yeah.
Yeah.
Again, so 2010 to 2011, this is like worked. So like, and we kind of diversify, like clients are doing well. I keep learning more and more and more about this. I've gone to a few of these due diligence conferences, and one of the ones that full cycle, we turn around like, you know what, that worked really well. We use the same sponsor for their next program, and client invests the proceeds. Like we take the money off the top, so we just keep the same initial investment, move the growth to a diversified portfolio. And so if it was like 20,000, we do another 20,000, and they start getting their dividend. And that's another thing, like, but this is a brand new program. It hasn't purchased a property yet. And so it's like, okay, they're getting this 7%. They're like, the money's coming from their own principal.
I too can take your money, give you some back, and call it a dividend.
Again, this is after the 17% going to the
after
fees.
Right.
And so it was this like this realization in like around 2011. It's like the clients, they only see that $10 share price.
Yeah.
That's the only thing they see. And they see that the dividend that's coming to them.
Yeah.
And so from their perspective, everything's working out just fine. Like they get a statement that says $10. They get a statement the next quarter, still says $10. And again, it was like late 2011, probably going into 2012. around 2012, one of the programs we had done did not do well. It was like going from $10 down to $5, and the dividend, which was, so again, it was like 70 cents on a $10 share price. So that's the 7%, goes down to like 35 cents.
Oh.
And so
they cut it in half.
They basically cut it in half.
Okay.
Just like something about it wasn't working, that like they weren't getting the cash flow that they expected from the program. And also, there's no incentive for them to sell when the properties are down 50%.
Yeah.
So like we're gonna ride this out until it recovers. Like, but we're now down like a 3.5% dividend, and like from the initial, even though the value is something. So like we're just gonna we're gonna ride this out. Like, this is the key message we keep getting from the sponsors. Like, oh yeah, it doesn't make sense to sell when our properties are down. We're gonna keep raising money, build up more properties, and sell it when we can sell it for a premium. And so it's that combination of like, yes, the short-term one went up, but we might be down for a long time.
And now, here's also a distinction on this being non-traded, meaning it's not mark to market and correct. The price isn't updated.
So it was about, again, 2011, 2012, I'm learning more, that the $10 share price that they get to like keep, I started to see again more independent research that tried to do a pretty good analysis of all the REITs that had gone full cycle. The kind of from the start, they raise money, they distribute a dividend, and they sell. So they're reporting these their data to the like Blue Vault and other things. If you can kind of combine the different time frames, and like this exit started here, exited here. We have another thing like started halfway and exit over here, and like seeing what those different exit prices were.
Yeah.
If you combine the different time frames, which is, again, it's not a perfect analysis, but it's still pretty solid.
Mm-hmm.
You end up with a volatility that looks actually a lot like the publicly traded REITs that we are trying to avoid in the first place.
Yeah.
And so, but the thing is, you don't see it. You see $10, $10, $10, 15, or $10, $10, $10, $10, 5.
Right.
Like, just because they didn't report the changes, and like there's like rules, that's a report every 18 months or so. Yeah. But like there's definitely some accounting factors, like they can keep that share price, or it might go up to like 10.05 or 9.95, like something like that. But there was kind of no incentive for them to increase the accuracy of their pricing. Yeah. There's definitely a strong incentive to like just leave it at $10. Like, hey, we'll send you a statement that says $10 share price.
Right. Yeah.
And so it was this combination of really nice due diligence conferences. I had a great time going to these in my late 20s.
Yeah.
Being wined and dined is really enjoyable. But this understanding, like, where's this money coming from?
Yeah.
Because again, they pay for me to go to these due diligence conferences because they want me as the advisor to recommend their program to my clients. Yeah. And so again, they're paying for me to go, and it's not even my money going to these things. It's my client's money is going to these things.
Mm-hmm.
And this was like this is like the genesis of like the first time I started to consider fee only. And like, oh man, I get these programs and I'm okay with our decision-making process going back to like 2009, 2010, when we first started doing these. I'm glad we diversified because the few clients that were invested in the program went down by half. That's only 1/4 of their total thing. Like the rest of them worked out fine. So their 100K didn't go down to 50, but they did not get the overall return that they were looking for.
Yeah.
I started seeing this application across things like life insurance. So I had my life insurance license at the time, and all of the advisors I worked for, they had also did life insurance as well. And I was pretty comfortable that we weren't selling life insurance inappropriately. We weren't pushing permanent life insurance. If it wasn't product, like the most common one would be like a second to die policy, where it truly is a state protection. Where these clients they were going to have estate taxes based on their net worth, because again, this is before a lot of the estate tax numbers had been increased. So I think going back to that similar time frame, estates over 3 million might have had an estate tax due. So we'd use that, but I did realize, and I've seen it with others, that insurance companies will provide rewards for the people who sell the most with that particular insurance company. It's usually designed for their agents, but it could apply to independents as well. And so the incentive was not necessarily to sell insurance or not, but there's a pretty strong reason to use the same company every time. That if I'm going to recommend is like, might as well use Prudential for all of these.
Right.
And
why shop around when one will do just as well?
Pretty much. And same thing with
advisor.
Going back, I was doing a lot of variable annuity research. This was a time where living benefit riders were starting to get really popular. And initially, so I first started researching these in 2005. The living benefit riders actually looked pretty good. Like they would track their account value and benefit value separately. And if your account value went up, your benefit value went up. If the account value went down, benefit value still stayed up. And you were guaranteed something like 5% per year for life from this number. And within 5 to 8 years, like I don't like been 2012, 2013, 2014, somewhere around there, insurance companies kind of realized like they'd kind of mispriced a little bit. And so instead of 5% for life is down to 4% per life per year per life.
When interest rates started to drop to zero.
Yeah, exactly. That's exactly what it was. A lot of their pricing was based on 10-year treasury rates. And as interest rates went down, they couldn't keep those high guarantees.
Right.
Also, again, the high internal fees of the variable annuities, which would be 1.5% to 2% for the variable annuity, another 0.5% to 1% for the investments. So it's like 2.5% for the annuity plus the investments, and then like 1.7% to 1% for the rider, the benefit rider. So the fees of 3.5%, like, yes, the way the math worked out, you could get 5% per life of that high number, but that was a flat number.
Yeah.
And all of the safe withdrawal rate research assumed that your income increases over time with inflation.
Right. Yeah. And
so as you do the math, the only way your 5% ever increases is if your account, so again, high benefit value, I'm trying to keep my hand, account value, is your account value gets higher than your benefit value.
Yeah.
But the only way to do that is to overcome that 3 to 3.5% in fees every year.
Yeah.
So it became unlikely you'd ever get increases in your guaranteed income.
Right. Basically, you would have to choose really risky, opportunistic investments.
So people realize that, and they were choosing those really risky investments. So the insurance companies started to limit the investments that you could do.
Right.
They needed it to be something like a 60-40 portfolio.
Yeah.
And so from 2005, 2006, 2007, like you could do an all equity program and get a guaranteed 5.5% of your high water mark.
Yeah. I've even seen limits of, but you can only put 20% in this one. And
exactly. So they started to kind of change the restrict the living benefit. The marketing
always
still
wins
works
somehow.
Yeah. And so it's definitely like those internal fees, like, okay, the most likely thing that happens with these variable annuities that were happening, that were issued around 2013, is you start with your high watermark, you take money out, it comes out of your account value. You spend about 25 years depleting your account value, you never actually run out of money, so you never get into the insurance company's pocket, and then your heirs get 10 to 20% of what you started. Like that was the like just the way the math worked out of the most likely thing to happen. And so it worked out as a longevity hedge. Like if you actually live long enough to get into the insurance company's pocket, then yes, there's that guarantee.
Meaning you probably needed a life expectancy that's maybe 5 to 10 years above the national average to have a chance of coming out ahead.
So it's like you have a 10 to 20% chance of reaching that far. And we probably could have done that with just a better withdrawal strategy and a lower investment cost.
Yeah, right.
So this like period from about 2008 to 2013, seeing all of these misaligned incentives and seeing actually where the money goes.
Right.
Was like, you know what? I have an awesome memory and picture of snowboarding in Park City, Utah, where it's so cold that you couldn't see any skin, like goggles, helmet, with like mask up to here. And I had a great time, learned about the unique alcohol laws of Utah.
Yeah.
That like the same beer on tap will be a lower alcohol content than the same beer in a can. They have these little clickers that prevent one drop more than 1.5 ounces being poured for any given drink. Again, this was, I think, a week after Sundance Festival. I think that's a big one they have in Park City, Utah, the film festival.
Yeah.
The picture I have over Central Park in New York, it's like that was pretty nice. Like it was a really nice view. Good trip. The Trump Hotel in Chicago was genuinely nice. I stayed at I think a Biltmore in Arizona once. That was interesting. I learned about like during Prohibition, the front gate is a good like half a mile from the hotel itself.
Yeah.
And so I'm pretty sure what that would allow to do, like if there was a raid during Prohibition, the front gate could call the hotel as like, hey, the police are driving through. It's like it just took so long for them to get
the tapping thing, the Morse code, like SOS.
So, but it's just that's where the money went. Seeing the Blue Wall report and like some of the lower cost REITs only had fees of 13%.
Yeah.
So like they're paying the dividend even though they don't own a property because the money's coming from that return of principal. It's your own money.
Right.
But they're pay a fee on and then send it to you. Yeah. And it's just none of these things are illegal. And most of the time with most advisors, these work out fine. They're not intentionally harming anyone. There are some benefits, but it was one of those things for me, I knew when I started my own firm, eventually I was going to be fee only.
Right.
The giving up the life insurance license to be able to sell term life insurance was one of those things that I thought about. And that's the only reason why I even considered keeping it. But again, that commission didn't need to come to me. The clients need life insurance. I use LLIS. It's a specific insurance broker that tries to keep their fees as low as possible. And so they're used by other fee-only advisors.
Yeah, I use them as well.
Their incentive is to meet the standards of all the fee-only advisors and keep their fees low. And because if fee-only advisors find out that they're not doing that, then they've lost their entire business model.
Yeah.
So it's understanding like where these incentives play just such a huge thing, especially when there's so much money moving around. It was again that feeling of this is my client's money paying for me to go have a good time in Park City, Utah.
Right. Yeah.
It's like I don't know if my clients would actually want me to go to Park City, Utah. and Chicago and New York and
Yeah.
I think it was Phoenix was one of the Biltmore was like, again, I had a great time. Again, like just like the age that I was the perfect time to go on these, but it was definitely eye-opening. It was like that's the like where maturity comes in, and I know good people who are not fee only, who don't abuse that, and they do right by their clients, but it's understanding where those incentives are.
Yeah.
It's I guess I don't I don't get upset at other advisors when they're not fee only, but I still like telling this story of why I'm fee only.
Yeah. Well, and just so we're all clear, basically, fee only is the notion that the only way you, Aaron, and me, myself, I'm also fee only, will be compensated is directly from the client to ourselves, meaning we are a zero commission business, no
Yes.
commissions or kickbacks or any sort of side hustle or whatever it happens to be, side arrangement between the products we recommend to our clients and us.
I remember when I first started my business, I had conversation with a friend who does insurance, and he was saying, "Hey, if you keep your insurance license, if you recommend anyone to me for insurance, I can send you a part of that commission."
Mm-hmm.
And it was definitely that feeling like I don't want to do that. Like it's so easy for him because again, he's making money on insurance product, insurance sale, and he wants
Yeah.
to compensate me for the referral. Like there's
Yeah.
a value there. And I was trying to say like, no, this is why I want my clients to be the only ones paying me. Like
Yeah.
at every level. It's like the word fiduciary is what the technical definition is, and I've had people ask about it, but it's never felt like people understand really what that means. But putting the best client's best interest at first,
Above
the
our own.
fee only, the fee only. I feel like that's the true display of that,
Mm-hmm.
where sometimes like and for me, another small distinction. If a client rolls a 401k over to an IRA that another fee-only advisor manages, like this might even apply to you,
Yeah.
your fees go up.
Yeah.
But if
Yeah.
they roll their old 401k over to their new 401k,
Yeah.
your fees don't.
Yeah.
And again, that's still fee only,
Mm-hmm.
but it creates this incentive where, and again, because the way I structure my fees, that doesn't exist for me. But so Trishul, you're fee only, and that incentive exists, and I think it's important to be open and honest and transparent about these incentives.
Mm-hmm. Mm-hmm.
About
Yeah,
what,
there's
like,
conflict of interest
yes,
anywhere, frankly, but fee only does go a long way. Not all the way, right? Because there can always be some sort of conflict of interest, but
yeah,
it does do a good amount of heavy lifting to reduce conflict of interest.
yeah. And I've heard other advisors that were not fee only, didn't necessarily. I didn't know them well enough to trust that they were doing everything right by their clients, but they would say kind of, how can you deal with money without and be conflict free? Like, yeah, you know what? That is a good point. There's going to be conflicts somewhere at every level, but that doesn't mean we should just kind of, everyone has conflicts, so it doesn't matter how you get compensated. Like, oh no, I think we can try to do better,
Yeah.
and I think that's probably the best. Like, I think we can try to do better.
Mm-hmm. Yeah.
And for you and me, that's why fee only matters.
Yeah. It's probably worth mentioning there is a middle ground term called fee based.
That's what my prior my prior firm was,
Right.
where about 80 to 90% of their revenue was from fees on assets under management. So
Yeah.
again, that
Fee only.
normal
Yeah.
1%, yeah. But then they also had insurance licenses, and so every
Right.
now and then they would do an insurance product or an annuity sale, and for them, their justification, I guess I'd say, is the commission structure has evolved where they can now say, instead of that 7% upfront, can I get 1% per year as long as the client holds this investment? And so they're trying to match the commission to what their fees on asset management are anyways. And they're trying to absolve. That's again, they're trying to do the right thing by their clients. So like keep it the same, but the client doesn't see what that trail is. They don't see what that number is. And so those internal fees are hidden, whereas the fee only side, they are transparent. It's a line item on their statement. They can see each quarter how much is being taken out. I think that transparency is better. But yeah, right. The prior firm was fee based.
Yeah. Wow. So I have so much to comment on because it's interesting. I had no idea what you were going to talk about with this origin story before we hit record here. And it's so interesting that I actually see a lot of parallels between my own personal origin story for transitioning to fee only. I don't know if we have enough time to open that whole can, so maybe we'll save that for another episode. But it's interesting, yeah, being in the industry and seeing how all of this plays through. You know, I think the perspective that I kind of saw it through is I was on the other side of the fence, meaning, you know, being on the hedge fund. You
were hosting the due diligence conference.
Yeah, I was the sausage factory. We were selling sausage, and we were, yes, whining and dining the other side of the fence. But the end conclusion, as our listeners probably realize by now, is very similar. We both transitioned here after seeing what's going on in these respective industries, and here we are, right? Because of it. I have a bunch I can comment on, but I just don't know if we want to dig into all of the other side of the fence things. So, maybe we will table it. But, one thing that I did end up doing right after I left the career and I took time off and nothing to do, I started a blog, which I mentioned way back, just because I thought might as well get my thoughts out there. And one of the first articles that I addressed was, besides why you should invest, was fees. It was basically, here's what's going on with fees. You should really pay attention to this because it means a lot. And the long-term ramifications of the fees, it can make a huge impact because these compound, right? Think about 1% compounding in somebody else's pocket besides your pocket. 1% over 30 years, that's 30%, right? But there's compounding of that 1%. So that can actually be like 50%. That's that's half of your upside. So imagine retiring with 3 million versus 6 million because of a 1% fee, dragging you down over a lifetime.
I think so I acknowledge that math, and that's one of the things, like, I still think that advisors provide more value than the fees that they charge. And so that kind of analysis assumes that they would make all the same decisions along the way. I don't think that's a fair assumption. I think working with advisors, if nothing else, that tends to be more push to save more, manage expenses, invest appropriately. So I acknowledge that math is accurate. I don't agree with the assumptions on how that play out. For me, it's even more direct in the short term, just like, where are the incentives? Why does an advisor recommend something over another thing? And acknowledging these conflicts of interest, acknowledging the incentives, because every human being responds to incentives.
Yeah, here's where I come out with the one, even the 1% notion. The question is, what are you paying for? Are you paying for the chance to outperform, or are you paying for advice that you can implement to make your life better than you would otherwise, right?
Yeah.
Whether it's peace of mind or whether it's actually doing things that you would have never thought of doing, right? Or are you paying for the chance to beat everybody else in the stock market? Something like that.
That's fair. Again, sometimes because a lot of the conversations that I have with other advisors are other advisors like you, where I almost forget that there's still advisors that charge 1% and just do investments.
Yeah.
It's like, oh wait, no, that's actually probably the majority of advisors in the country.
Yeah.
And so for me, my default is like, I'm trying to make my clients' lives better. They're paying me so I can help them figure out how to quit, not to beat the market.
Yeah.
So that's fair. The assumptions that I make when looking at the like compounded 1%, like, you know what? There probably are a lot of advisors that math does directly apply.
Yeah. Well, for example, the portfolios that I recommend, they have a fee of like 0.05%. They're all passive in nature.
Yeah.
And an actively managed analogous portfolio, based on industry average, is like 0.6 to 1%, just on the actively managed outperformance fee, because you're paying people to try to beat the market somehow, which the data shows adds zero value over time, right? So that just on its own. Now you change that to like the 3.5% numbers that we were just talking about, and oh my God, head explodes.
Yeah.
Right? Like, how?
There's, you get fees of like total fees that, which again still exists with a variable annuity with a living benefit rider, is going to have a fee of at least 2%. Would not surprise me if it's up around 3%.
Yeah.
There's no way to get any kind of outperformance on any longer term time frame if you're taking withdrawals. You're just going to see your portfolios go slowly down. Like you might get a 1 or 2 year spike, but it's gonna drag it down so quickly that there's no way you recover. Like the decline is gradual over 25 years, but it happens almost immediately that you never get above your starting value and just keep stepping down.
Yeah, standard hedge fund fees 2 and 20, so 2% right off the bat, 20%.
Still a lot of people paying that.
Yeah, so on a 10% gain, that's 4%. That's a 4% fee.
Is there super side note? Like, is there usually a hurdle associated with that?
Yeah.
Like the 20% doesn't start until like a 10% return or something like that.
Well, 2 and 20 is like the norm, or that's the ask, I'd say. That's the ask. And then there's everything else, any other possible combination. Like you got to beat LIBOR plus 5 plus.
Okay.
Whatever it happens to be, you can come up with any fancy thing. Sure.
Okay. Have you ever been to Park City?
No, I haven't. I haven't been to Utah.
Have you ever been snowboarding in like the Rockies?
We did Tahoe. I did Banff. I did. I think I mentioned I broke my arm in the German Alps.
Oh, I don't think I knew that. I don't think you mentioned that.
I don't know. I had to be airlifted off of a glacier on top of.
No, I did not know that.
So here we are.
That's a better story than mine going to Park City.
Oh boy, I don't even know where.
Okay, if we're gonna go, okay, so your challenge is how do you relate being airlifted to your firm's origin story?
Was that when my spider bite happened?
Yes.
In the hospital? All right, that sounds like a good homework assignment.
Okay. So if anyone listening wants to ask me more details about commissions, fees, about my kind of past life, past firm, again, they didn't do anything illegal. They didn't do anything even dishonorable. Like I agreed with them. I don't think I was doing anything wrong at the time, but it's informative where I got to where I am today.
Yeah.
So I'd love to hear other stories of people trying to understand these distinctions. Like I know like commission versus fees, fee only versus fee based. Like these are industry jargon that I don't think most people really get, that I'd be happy to try and help other people understand, because they kind of do matter, but but they're not marketed well to the general population.
Yeah, I think it's fair to say that there is a website, Fee Only Network, if you're looking for fee only advisors. But we're both on it, right? You are,
Yeah,
Aaron.
I am.
Okay.
Yeah.
So, frankly, if I didn't know anything, or if somebody said, "Where do I find somebody who's fee only?" I'd say, go there, right? And maybe start your search that way.
XYPN is also fee only, so they have a find an advisor function, and NAPFA, the National Association of Personal Financial Advisors, is also they're also fee only.
Okay. I'm in all three. I should probably know that.
So, because NAPFA and XYPN have a relationship where, like, if you're in XYPN, they make it easier for you to join NAPFA as well.
Right. Yeah.
So, okay, that was my story of when I went to visit Park City, Utah.
Good stuff, Aaron. I didn't know any of this, so I'm very happy that we had a chance to find out why Aaron became a superhero.
Is that our title?
You can
my feeling matters is probably what probably makes more sense, but I like yours better.
You see Aaron with a cape wandering around downtown San Francisco, you know why.
Okay, sounds good. I'll talk to you later, Trishul.
Okay, good stuff, Aaron. I enjoyed this conversation. Again, if you are enjoying these, do comment, like, subscribe, and share. Thanks, everybody. Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.
Yeah.